Welcome to the Dividend Talk podcast, episode 156, the latest about Kenvue split off and quarter two in review. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Yo, European DJI. It feels like ages since I spoke to you on the show. How are you, my friend?
I'm doing really well. I got a little bit tanned from the sun. South Europe has done me well. And yeah, we haven't spoken for like 3-4 weeks, right? Because we were both on holiday. We had some pre-recorded sessions. So this was kind of our summer break. And yeah, fully back again. Sorry of course, to our listeners for missing out on the last episode last weekend. It was just impossible for us to get together. But other than that, I'm doing really good. The summer is really good. It's a bit too dry, I would say, in Europe, and too hot. But for the rest, it's just a lovely summer. How about you?
Yeah, I'm sure the Irish listeners here are cursing you because there's a heat wave all over Europe. We can see it on the news. And when I say it's raining, it is nearly hailstones every single day for the last 3 weeks. It's actually crazy. But before that, I was on holiday, so I got a couple of weeks of sun. I'm also tanned. I've got a new haircut. I'm matching there a little bit. I shaved my hair off, so it's it's fun. Hey, it's good to be back though. I kind of missed it last week. I liked the 2 weeks off was nice, but I was ready for it last week. But I'm certainly ready for this week. We've got a jam-packed show. We've got lots of earnings, and we've cut it back a little bit, and then we've also got our own portfolios to review as well. So I'm looking forward to it.
Yeah. Yeah, the fun fact is, right, this is typically a cucumber season, so there's nothing worth mentioning, but I would say in the investment world, you have second quarter earnings always coming in. So that's the nice thing about investing. There's always some news, even during cucumber season. So we don't need to go to the field and pick those nice cucumbers and make pickles out of them. We can actually talk about investing. So tell me, what was in the news this week?
So couple of things in the news, but probably one of the biggest ones was the results from Johnson & Johnson, but also the spin-off Kenvue. A lot of people were surprised they did quite well compared to their expectations, and I think they announced the dividend as well. So a lot of people were excited around this company. What were your thoughts on it?
Well, the first interesting thing, of course, and that was for me the big news, is that they finally gave some clarity on what they will do with Kenvue. So they spun it off. They already launched it. They still have a stake of 90% or something like that. And there was this question like, will we get shares or not? Yeah, now, here's maybe for new listeners or for people that are relatively new into investing. And I must confess, I also had to look it up again. There is a difference between a split-off and a spin-off. When they do a spin-off, typically you will get some shares into your account. You don't really have influence on that. You get them into your account, and you will see the share price drop from, let's say, Johnson & Johnson, about the amount of what the new shares are worth from Kenvue. And often you have like let's say a 10-to-1 or something like that, all depending on what the market cap and the transaction details are that Johnson & Johnson decides on. But the split off is something else. A split off means here that effectively what Johnson & Johnson is, it's going to offer us that we can exchange our Johnson & Johnson shares for Kenvue. So we don't get additional shares like a spin-off where we effectively get to hold both. No, we need to make a choice here. So the benefit for this is from a Johnson & Johnson point of view is that there's a lot of tax advantages to that. Also, little cash implication here. So they believe also it's better for shareholders from this point of view. But I generally prefer spin-offs, and I want to decide myself what I want to do about it. At least I'm happy that they are not just spinning it off, keeping the cash on the balance sheet, and the shareholder doesn't see anything from it. General Electric was a company that did this when I was holding them. Yeah, I'm not a big fan of split offs. I prefer spin-offs, not split offs. Just give me the shares. I then decide what to do with it, whether I hold them or not. And with a split off, the issue is that I then need to decide, should I trade my Johnson & Johnson, the medtech and the pharma part that is left behind, in exchange for the consumer staples? And I don't want to pre-present it with such a choice. Just give it to me and then I decide whether I sell it or not. That's much easier for me as a shareholder.
Yeah, yeah. When you almost read it, it looks like that it's a typo, because I haven't seen split off on it before. So it was interesting to actually come across that. And then with that choice, I mean, look, it's probably a no-brainer, because Johnson & Johnson also released their earnings, and this time MedTech was on fire, as you posted on Twitter.
Yeah. So that was surprising to me, right? MedTech was not doing so well over the last few years, and the same applies to Medtronic. So I'm also really curious to what Medtronic will do, because Medtronic really needs some improvement in free cash flow. They are getting tight with their dividend payout. But yeah, no, Johnson & Johnson did really well with the MedTech division. I believe, what was it, plus 9% or something like that. So that is just really huge for a company like Johnson & Johnson. Their sales grew year over year by 6.3%, which shows that they have pricing power as well. Earnings went up by approximately 9% if you take the normal EPS, and 8% if you take the adjusted EPS. And I'm talking here about the quarterly earnings.
Yeah.
So, the share price also shot up, and I saw some people that were surprised by it, but I wasn't personally surprised by it. And the reason for that is, like, Johnson & Johnson has been going nowhere really with their earnings over the last few 2-3 years. Yeah, so, and you saw that back in its valuation as well, because it was all the time trading around the 2.8 to 3% yield for a high quality company in this environment where stocks are generally overpriced. That's not a high multiple, also what you're paying there. So now it's showing growth. So yeah, I can imagine that the market rewards that pretty well. And yeah, for me, it's like it's good to see this. It's good to see that also pharma is doing okay-ish. I also read somewhere that they are making deals, and I forgot the two companies regarding, I believe it was Stelara and the biosimilars impact. So when I read the earnings free notes here, they are making deals with those biosimilars that could really take their revenue away. And then have extended the factor or protected Johnson & Johnson sales till 2025. So I don't know how it looks like. That maybe someone, an industry insider, can share that a little bit with us to educate us. But to me, it sounds like that what Johnson & Johnson doing is saying, for instance, to those two companies, like, guys, you know what? I'll pay you this. Probably is a little bit more than the revenue you could earn. Yeah, if you withhold with entering your biosimilars on the market. And I get to keep my revenue for the next 2 years, which is probably much more than what the payment entails to those two biosimilars companies. So that's how I understand it. But again, I'm not an industry insider from that point of view, so I would love to hear it from someone else how this works. But yeah, that's one way where you can also see the pharma is a bit dirty, right? Because with this, you're not helping the accessibility to patients that want cheaper pricing.
Yeah, I mean, you're helping shareholders, but you're not helping patients. But it's sort of a win-win with the way you described it. It's sort of a win-win for both. Johnson & Johnson get to keep their revenues, and you said those two companies have guaranteed income for these 2 years. So if they're in the development stage, I don't know how big the companies are, but with guaranteed cash, they could probably develop and do a little bit more. So,
yeah. So I'm not 100% sure about if it works like that, right?
Yeah,
but that's how I
course,
understand it from reading this.
Yeah, interesting. So the question is, what are you going to do with your shares? Are you going to keep all Johnson & Johnson, or are you going to split it anyway?
Yeah, and we got this question also from Hobby Investor, right? What we think about Kenvue in general. So I'm keeping my Johnson & Johnson shares. I don't want Kenvue shares. It's a consumer staple that, although they did pretty okay, it's not something that I get excited about. I have already some other consumer staples that I prefer to have more in my portfolio. So at this moment in time, not. There might be in the future, maybe one day that I feel like our Kenvue is a right fit, but at this moment in time, I will not take those shares. I rather keep my Johnson & Johnson shares.
Yeah.
How about you?
Me too. Me too. I'm not taking the split off. I prefer to keep pure medtech Johnson Johnson in this case. I have enough consumer staples just like you. So
yeah, good.
Okay, so before we dive into any more earnings, we might have a little look back and see how we both did over the last quarter. Look, this quarter is pretty big in terms of European companies, so I expect both of us might have done quite similarly. But talk us through your quarter. How did you do?
Well, May for me was an amazing month, but also June. So on average, my net dividend income compared to last year, so dividend after tax, grew on average by 20% year over year. And this is just a lot. In April, I actually had a small decline of 8% that had to do with, a dividend payment falling in the first 2 days of May instead of the last day of April, because I take the dividend dates when they enter my account, not when they are should be paid by the broker, by the company, because there's sometimes a few days delay.
Yeah.
Then in May it was 12.5% more, but in June it was 59% more. And June was always a weak dividend paying month for me, but it has drastically changed because of, for instance, the acquisition of NN Group in my portfolio, which I didn't own last year around this time. So 20% more is a lot, Derek. It's really a lot. It's of course also above inflation from that point of view. It's fair to say there has been a lot of cash contributed to get here as well, because I continue dollar cost averaging into the market with my salary. What is also nice that from all the money that I invested, 27% was reinvested from dividends. So this is also where you see the power, right? Where the dividend are really contributing to my compounding and my investing at the moment. And that's a lot, because I'm not disclosing the absolute numbers here for privacy reasons, but we're talking already about large amounts here. I also sold some shares. I didn't sell all my shares in 3M yet, because I'm doing that in a staged approach here, but I sold some 3M. I sold also a share few share. No, I don't know if it's a few shares or share, but I sold some Google. And I sold entirely my digital realty trust. Here I can say I had only like 5 shares or something like that. So that was once an initiating position to learn more about the company, but I really don't like this company. They're like AT&T and Verizon. About AT&T and Verizon, there was also, of course, a lot of news because of the lead cables in the ground that the Wall Street Journal reported on, that they can get a lot of potential litigation here, but generally AT&T and Verizon, specifically AT&T, I looked at them, and since the mid-90s, till now, they have not given you any dime in capital appreciation. 30 years, in the biggest technology boom we have seen in the human race via the internet technology, let's say, and they are a play in this whole internet technology space by providing the internet to people's homes.
Yeah.
They've not been able to reward shareholders other than dividends over that time period. And that's, for me, is really flabbergasting. And, that's also why I don't want to own telecom operators, neither in Europe. I don't understand how they are not able to benefit from this. And now people are telling me about 5G all the time. But with 5G, I have exactly the same. AT&T and Verizon are investing in 5G, but who is the beneficiary of this? Google, Microsoft, all the other kinds of internet businesses that get benefits from the quicker speeds.
Yeah.
Because we as consumers, we don't want to pay so much for our internet. There's competition there between those telecom providers. So it's just a poor business, in my opinion. And for me, digital realty trust, I'm noticing the same, because the whole bull case for me was here like, the growth of data centers. Yeah, with the cloud and everything, and the hybrid cloud. I thought digital realty trust will do well, but their free cash flow or their funds from operations are going nowhere. So it tells me that they don't have pricing powers. The negotiation is powers on their clients, not on Digital Realty Trust. So I stepped out of it.
Yeah.
Here in Alphabet, I just sold a little bit because I doubled my position. It was part of my growth portfolio. So I sold half and let the rest just play with the house's money, as I say. So all in all, the stocks that I bought 2 times T. Rowe Price during the quarter. I bought some more CIBUS during the quarter. I bought 2 times Realty Income during the quarter. I bought some Target. I bought Nationale Nederlanden. I bought ASR, and I bought Legal and General. So again, quite some insurance companies, plus 2 real estate companies, plus T. Rowe Price. These are all lots of high yielders actually here, but I'm especially proud of my Target. I've been waiting on them for a long time and finally have it.
Yeah.
My portfolio yield went a little bit up from 3.7% to 3.8%. My portfolio growth, when we talk about absolute numbers, grew by 3.2%. That's not a lot compared to last quarter, but has to do with how stocks generally performed in last quarter, plus a little bit the currency decline of 2%. Shell remains my biggest position, although where it was last year almost 9%, it's now 7.5%. And this is what I always mention, like, I had some bigger positions in the beginning, but while my portfolio is maturing, I'm getting more and more to these 4%, 3% level as part of my allocation strategy. Just when you're in the early 2-3 years, it's hard to do that. And it also makes not a lot of sense to do that. There's just some single stock risk more, of course, when you only have 2 or 3 stocks than when you have 50 stocks. I'm now around having 40 something stocks, but still you buy when opportunities arise. But now finally, let's say after 9 years of investing, I start to see really the diversification kicking in, because every time there are some opportunities there. Here, and my allocation strategy is really coming more into shape right now. So yeah, I'm really happy with that. I think half of my investments this quarter was with fresh capital deployed. The rest was from dividends and the shares that I sold. So yeah, happy. I'm very satisfied with my performance, and my projected annual dividend income is going into the right direction. It grew 8% in the last quarter, which is a lot, but also, when you think about ASR, Nationale Nederlanden, Legal and General, those and CIBUS, those are high yielders. So
yeah. It's it's pretty impressive. What's quite interesting from my standpoint here is that you've made 5 purchases within the financial sector, but it's still not your largest sector holding. Information technology is still trumping that.
Information technology is because of just Microsoft and Apple. I mean, with the AI boom, they just keep increasing my portfolio. Yeah, that's true. I always say bankers are wankers. I have a little bit of a different feeling for insurance companies, although some of them also do a bit of banking, and specifically, I believe Legal in General is, of course, also an asset manager. So, but it's for me not a traditional bank like Wells Fargo and these kinds of banks. There was one other thing that I wanted to say. Yeah, there's one thing that I'm maybe not so happy with, to be fully transparent. I wanted to invest more in high quality companies. Yeah, this year that was really for me a thing. But I find that the highest quality companies, I just feel that they are still too much out of reach, and the insurance sector, what they are trading now, was for me an opportunity that I just couldn't ignore. I'm laying the foundation now, but this is like energy. Once this industry starts recovering, I will probably not touch it for maybe several years even. Yeah. So that's still in my mind. This high quality, I'm not happy with, because I've written my goals and I'm reviewing my goals often, and I'm not satisfied with that one yet.
But sometimes you have to take what the market is giving you as well. Sometimes
exactly.
That is the case. I've one question around April. It has negative growth. It's the first time I've seen you with negative growth in the 3-4 years we've been doing this.
Yeah, that's what I mentioned. This was the difference between the dividend payment falling in the first 2 days in May versus April. And April is a really low dividend payment month for me.
Okay, nice, awesome. So you're happy overall. It's fairly strong, fairly good progress.
And it just shows that dollar cost averaging, compounding, and being really consistent just works. Yeah. And also to the listeners, trust the process. Just trust the process. Anyway, how too much about me. How have you been doing?
Yeah, so I've had, do you know what? It's been an extremely good quarter for me. I know you don't share numbers, but I do. I don't share on my blog as much because I don't write, but I don't mind sharing a little bit. But I'll just tell you about my income over the 3 months. April, I hit €268 monthly income. May was 645. That was a record. And then I broke that record in June, which was 729
Wow.
income. So an average over the 3 months of 547. I remember
Wow.
I was listening back to one of our earlier episodes, maybe in year one, and I was looking forward to reaching the €100 monthly average. And
Yeah.
now I was hitting 500. So it's quite something to reach that. But like I was saying earlier, it is heavy in European companies, so it obviously spreads out throughout the year. But that total there, that's about €1,600. That's half of what I earned in the total of all of last year, which which is mind-boggling.
Wow.
So in one quarter, I've earned half of what I earned all of last year. So I'm quite actually chuffed with those values. If I look at some of the companies that I got dividends from, HPQ, there's WPC, there's Ahold, there's a couple of closed-end funds from the UK that I own. AT&T are still in there. They still pay me dividends. Blackstone, and then obviously our financials. We got NN Group, we've got Legal and General, we've got Shell, and Walgreens are still chugging along. So there's quite a list. I know you can see the full list here. There's quite a list of companies there that have paid me dividends over the 3 months. So it's quite inspiring to look back and see those averages move up over time. I must admit. My portfolio yield, and we discussed this quite a bit. It's always interesting. Mine is nearly double yours. It's not quite double. It sits at 5.54. But I mentioned some high yielding companies there that I own, and the closed end funds are typically 6-7% as well. So it adds up over time. Shell is still hanging in there as my largest company at 8%. I think it's close to the same as yours. Financials, you'll be not surprised, is now my largest holding at 27%. Consumer staples is at 23, followed by energy. But I did buy a lot of T. Rowe Price. I did buy a lot of Legal and General, NN Group, and Chesnauer as well. I topped up on them, reinvesting some dividends. So I have been buying some of them. In terms of my buying and selling, so I just segregate my buys first, and I was like, wow, I bought 13,000 worth of stocks this month. But actually, what had happened there is some of the crap that I owned from options. Remember, I talked about CCL. They finally bounced back and reached the point where I could break even. So I sold them. I got rid of them straight away. So I'm only holding 2 more companies from them. So I sold roughly around 7,500 of that, and obviously reinvested that into dividend companies. More specifically, I bought VG and CRH. It was actually a good time to buy CRH because they've given me nearly a quarter back already in share prices after going up 25%.
Wow, because this is a cement company. And tell me, I see Anagas in there.
Yeah,
I'm surprised to see that because I was actually looking this week at Anagas, thinking like, around €15. I've got such a small position. I thought maybe let's double the position. I see it here now.
Yeah, I mean, my thinking around Anagas is they have a dividend floor in for the next 2 to 3 years. So you know what your dividend is.
Yeah.
The share price, I mean, look, with the Spanish government, they sneeze and then the share price goes down. But my fair valuation is around €18. I think €18 is fair, 17 to 18. I think they're trading around 16 €16 when I bought
like that.
So I thought it was a no-brainer. Just topped up. And yeah, I collected dividends from them again as well this month. So yeah, I still like Enegas, and I do really like that they have that dividend flow, so you know what you're getting. And at the moment, I think the dividend yield is 10%. So even if they were to cut it, which I don't think they will, it still probably give you 6-7%. So it's still quite a decent yield. So I think the risk to reward is quite decent there. Just to finish off the recap, my total actually invested was 6,000 if I take away the crap that I sold. But 4,500 of that was my own cash, and then the remaining 1,500, it's probably 1,600 was the dividends, reinvested dividends that I received. My overall dividend income for the first half of the year is 2/3 of the way of my full year last year. So I expect to break last year's numbers by next quarter and then see where we end up at the end of the year. But I'm aiming for around 4,500. That's what I'm hoping for. So yeah, overall, quite happy with how things have gone. Like your comment there actually triggered me when we said high quality, because I think we both spoke about that at the start of the year, and not a whole lot of high quality. There's a lot of high yielders there, a lot of insurance, a lot of financials, and I've also been buying British American tobacco as well, because I think they are fairly valued as well. So yeah, quality is something I need to work on, but I'm quite happy with most of my purchases, I have to say.
Yeah, so maybe good to disclose, right? When I talk about high quality, I'm of course talking about let's say the Louis Vuitton of this world and these kinds of stocks, right? And maybe even a little bit less quality, but let's not be mistaken. I think that NN Group is a really high quality insurance company. I think that ASR is a really high quality insurance company. I think that T. Rowe Price is also a high quality asset manager, right? But I was more thinking about different sectors, maybe in the consumer staple, or maybe more those that are my foundation stocks, maybe some more, or maybe an initiation in Nike or something like that. And that just, there was no opportunity for me, but I need to go back to this. For instance, I'm now looking a bit more into Assa Abloy. We'll speak a little bit later about it, but I want some more of those companies. That's what I mean with high quality.
Yeah, my thoughts are similar. Like the likes of Nike, even Johnson Johnson, Microsoft to a certain extent. I haven't bought. I think I bought a couple of shares of Johnson Johnson, but none of Microsoft. Even those types of companies would fit into my criteria of quality, which, as you can see, are not on my list. So it's
but if you buy some Micron and some software AG from Germany, then you combine them. You have Microsoft.
Add them together. Yeah, I seen your tweet this morning. It was quite funny.
No, well done there. It's really nice to see your performance. And I also noticed that you are able to contribute more and more cash. Has this to do with your savings rate here?
So as I bump up in work, I just
I
throw it in here. And you know what? I was holding some back. I've noticed last year I was holding some back when I was doing option trading. So I don't have that restriction anymore. So I can freely invest that in. So that's fine. So I'm at about 1,500 a month. I'm hoping next year to get that to 1,750 and then 2,000 and so on and so on.
But I think that's something that we don't speak a lot about, but it's so important. In the beginning of your investing career, the savings rate matters so much, because you get more money added to your portfolio via your savings rate than via dividends. For me, it starts to change now a little bit, that my dividends really are meaningful, and actually for you this quarter as well, as I can see. But I think doing your best at work, getting that promotion or getting this pay raise, and being able to avoid lifestyle inflation is probably the best wealth hack there exists in the first 6-7 years of your journey, at least when doing dividend investing. I think it's maybe not often spoken about, but that's really what's giving most of our performances, right? It's our salary increases and being able to prevent our lifestyle inflation on the expenses.
Yeah, and I know we're quite similar in that respect, because I don't know how many times we spoke even before podcast. We didn't have a chance to do anything because we're always working late and we're so busy. But I do agree with that. I think focusing on your work is super important. Getting yourself into a position where you can make meaningful contributions, and that will only happen as you get better and better and you work more respected and earn more money. So my primary focus is always my work until I get to a point where I don't need to anymore. But until that day happens, work comes first. So we've been on calls and I've had to stop and go into work and stuff. So that's just a sacrifice you have to make. But on the plus side, I can see the benefits of those increased contributions. It's only an extra 250 a month, but that's every 4 months. That's the same as 1,000, which is what I started at the very beginning. So
that's 3,000 a year.
Yeah,
3,000 a year. Yeah. Good. So hey, well done. Let's see how Q3 will do these summer months. I'm already looking forward to it. But let's also quickly touch on a few of the earnings before we go to the listeners' questions. Is there any earnings that you wanted to chat about?
Yeah, of course. ABB is a company I speak about quite highly. It's a company I own a small amount in, a trading 212 pi. Always seem overvalued, but they released their earnings for half year this week. And they did actually okay. Their orders was around 8.6 billion. Obviously they had a huge backlog, we know, and they're starting to release that backlog. So that's helping with the orders and the revenue. The forward orders has gone down slightly, but there's a lot of weakness, as everyone knows, in Asia, particularly China. So that has impacted them slightly. It's not overly concerning given the orders backlog that they still have, so they're still able to keep up with that. But just be aware that the China slowdown and all that is contributing to that. I have to say it's as I pretty much expected. It's not as strong as last quarter, but overall the half year has been pretty strong from the company. What I like to see is that their cash flow is now positive. It was negative last year, and the impact that had was that they had to take out some debt to pay their dividends and buy back shares. So it's nice to see them back cash flow positive. But that's just one thing, and I think I mentioned that the last time, is to be aware of, is that they were cash flow negative and they did have to borrow to pay that dividend. And that's something I don't like to see, and it's something that I need to monitor over a longer period to make sure it's worth investing before I invest in them. But to say going forward, I'm not too concerned about that. They shouldn't have the same impact as what they had last year. They're starting to get through those orders quite quickly now, so their cash flow should improve. They are also quite active in their acquisitions and divestments. They are working more towards electrification and motion, which we spoke before, and you can see that in their acquisitions. They've bought a company from Siemens, they bought EV Systems, and they've bought 3 other electrification businesses, while also divesting their process consultancy business as well. So they're trying to move away from process automation and more so into electrification, which I believe is the right move to make. But I think overall it's quite positive. It's not blowing us away, but it's not bad either.
But what I find surprising, right? Because we both have, in my past, and you maybe more recently still, experience with ABB products.
Yes.
And for me, they were always top notch. But then we have now been looking at ABB for 3 years, and I just don't see it. I don't just see it floating into the balance sheet, and that's the awkward thing for me with ABB. The products seem to be really good, but then the business itself, there is something wrong there for me when I hear you talking about cash flow negative last quarter and now a little bit above. Yeah, that is optimistic, but there is something there that just I don't know why the business is not able to spit out more cash. I don't understand it.
So the only thing I would say there is that all this moving into electrification, if you look at even at Europe as a whole, they're talking about reducing carbon emissions, improving particularly in Ireland, but all of Europe, improving the electrical system. All that is giving a date by 2030. That's always the date that has been given. So I think that's the date everybody's kind of aiming for, to reduce carbon emissions, to have smart grids and all this. I think a company like ABB are spotting this, they're seeing this, and they are moving more into electrification for that reason. It's not now, it's not straight away. We still don't even have enough electric cars, even the system to facilitate that throughout Europe. So I think it is more of a forward-looking project rather than now. I think what they have now is like a steady baseline, but to move into the future, I honestly think electrification and motion are the two that they should be focusing on, and they seem to be doing that. So I'm actually quite happy. I'm happy if they stay steady over the next few years. But if I'm sitting here in 3 years' time and I don't see it starting to creep into the balance sheet, I will probably have a little bit more negative view, like yourself. So
because I'm comparing this to Siemens. I know we cannot compare them one-on-one with everything in their business lines, but then I look at Siemens, who's also looking at all of this, like wind power, electric, the trams, everything, and then the public transport. And I think like they're hitting it. Yeah, they're doing it much better, in my opinion. At least they seem to have more momentum, and it seems to translate also into their income statement.
Yeah, I'd agree, but I think Siemens probably have more pricing power and brand power when it comes to that side of it, particularly with renewable energy. ABB, you remember ABB, they came from transformers, and a lot of
Yeah,
people
yeah,
still, before we even did the show, I kept thinking they were still transformers, and even still in process control like PLCs. So it is a bit of a shift in terms of what they're doing, and people probably have to move with that.
yeah,
With that, but I honestly, if it was Siemens or ABB, I'm Siemens all day long.
yeah, yeah. Same here. Good, good, good. Well, thanks for the recap. Maybe then I want to pick one out, and it's actually nice. We have only European companies here, except for Johnson Johnson in the beginning. But this one that I want to talk about was Novartis, because I owned Novartis for 2 years or something like that, and I sold it because the stock was going nowhere. And if you look now at what Novartis did, I mean, they grew their sales by 7% and their earnings per share by 17%. They had a small free cash flow decline then. But the top-selling drug, Anestor, grew at 35%. And I was a little bit surprised with this one because, in the beginning when my thesis, when I bought Novartis, I thought like, data science getting more and more important to discover drugs, and the company started investing in it. The CEO really spoke the language that I liked. Then after 2 years, 3 years, I just saw nothing happening. I just saw it wasn't working what he wanted. Yeah, and now suddenly with the new medicines, it started to pick up. So maybe it was too early with selling. Who knows? But the company is actually having pretty good numbers right now. So it surprised me, I must confess.
Yeah.
And what was really nice is that this innovative medicines division that grew by 9%, which is a lot, 7% in constant currency. And yeah, they also initiated now an up to 15 billion share buyback. So they're really confident themselves, and they want to complete it by the end of 2025. So that's like 2.5 years for now, which is approximately 6% of their entire share count, which is a lot.
Yeah.
And yeah, if you look at it, there and Entresto, and then the other one, Kesimpta, that they're just growing really rapidly at the moment. So they have a few drugs that are really on fire, while the other drugs that are in the top percentiles of their sales are kind of flat or still growing by 10% or something like that. So overall, they had a really strong quarter year-over-year. Now, on top of that was probably when people are interested in Novartis, just know that they are, aiming and intending to spin off Sandoz, which is their generics business and biosimilar business. So they will list it on the Swiss Stock Exchange and also create an ADR for people that are interested in there. And this will be a spin-off, not a split-off. So people will, I assume, get those shares. But this was good for Novartis, and maybe this strategy is coming a bit to fruition. I mean, of course, we have the 35% dividend tax here. They don't have the Roche ownership stake anymore. So maybe the portfolio decisions that they have been doing are finally coming a bit to fruition.
Yeah.
And maybe they are becoming finally a more focused company. I mean, on social media, we have some people that consider themselves insiders or call themselves insiders. And this is what I generally know about Novartis, is that they have really an issue with employees, low morale. I often sense that there. So I don't know, I don't know if these numbers are also a result of, for instance, cost cutting, severe cost cutting and such. So, but overall, bottom line, if you just look at the numbers, yeah, they had a really strong quarter and really surprised me. So kudos to Novartis, I must say.
Yeah, nice one. And like you, it is quite surprising to see that they've kind of been not a dead horse, but kind of flat for quite a while.
Yeah. We've discussed them before on the show, right? And it was a bit same old. So
yeah.
Good. So Novartis really good. And then maybe a next one that I mean, this is a stock that I really dream about owning, and that's the locksmith of the world, Assa Abloy. I mean, they grew their sales by 17%. Of course, they acquired HHI for, I think, 3-4 billion in, I believe, euros or dollars. So the debt went a bit up, but it's still really in a good range. And this is also within the sales numbers. So 6% of comes with, I believe, but 3% organic sales. And if you just look at this company, also their margins increased from 15% to 16-17%. It's one of those strong compounders. Well, if we get a global recession, if the real estate market is really hit hard, you would expect to see it already in the numbers here. So they're still able to grow 3% organic, while the office REIT space is really in trouble. All around, specifically Europe, but also more in the world. So they're still able to grow sales. But if there will be really a recession, I do expect it to be impacted if the real estate market, of course, holds back their investments. But yeah, Assa Abloy, I love everything about this company. I just the pricing, the pricing it is.
Just the pricing, and I'm going to talk about a company in the same region, which I also think is a quality company, which is Evolution AB. I remember we spoke about them on this show, the gaming, online gaming operator. At the time, we both said quality company, definitely an area you should probably invest in, but the dividend yield is quite low, sub 2% at the time. But man, look at the numbers these guys turn out. Their operating revenues increased 28.2% to 44.1 million. Their EBITDA increased by 30.8%, and their earnings per share increased to 1.24, up from 94 cents. The numbers are pretty good. Their profit margin, it hovers around 60% as well. And what I like about them actually is that they are also launching in Latin America as well. I think that's incredible. I think that's a huge market to go into.
Yeah, well, for me, it is a company that I didn't hear about because I'm generally not following casinos and such. So that's why I don't own VICI as well. I don't understand it so much. But it's kind of also proud, right, to have a Scandinavian company doing so well and really, making a lot of headway out of this. It's really nice to see, actually.
I mean, if you scroll down, they have lots of blurb there. What they say is, right, in Europe, the demand for new tables exceeds their current delivery capacity. So the demand that they're getting, they can't actually keep up with it. So now they have a backlog of orders to keep up with the tables that they need on top of a 30% increase as well. So the demand is there. They just need to make sure that they can deliver that as well. Otherwise, a competitor could come in. But I mean, I think this is a quality company. I would love to own it. It's just the dividend yield is really low.
Yeah. Okay, well, maybe we still need to look at the one time, sometimes like thinking buy some legal in general and then a bit of evolution, and you have a nice average yield, and you benefit from both growth and yields in your investment, right?
Something definitely to consider.
Yeah, good. So these were some of the earnings results that caught our attention. Of course, we will get still some really great earnings upcoming in the next few weeks. But let's start with some of the listeners' questions.
Yeah, let's start with the first one. So, Dev Sloot asked us about letting your winners run. I know you wrote a blog post on this, so maybe there'll be a little bit of a discussion on what do you mean by letting your winners run.
Yeah, so in my blog post, I made an argument that generally what I learned is to let your winners run, and I use Microsoft as an example because the CEO in leaked court documents came forward that they are having a target of 500 billion in revenue by 2030, and they are now making 200 billion in revenue. So that's still 2.5 times more. So I did the math that even at the $360 share price, at a 40 multiple right now, if you let this company just grow, you will still net about 9 to 10% annually in share price. Because if you take 500 billion and you use the same margins, profit margins around 30% that they have now, and you would do that at a multiple of 30, and even if you take also some share buybacks into consideration, what they are doing, 1% a year, you will still, this will go to 675 at a 30 PE. And I think a 30 PE with such growth numbers that is growing like 13% in revenue or something like that each year, I think is valid because we're talking about high growth. Now, the question is, can it continue like this for 7 years? Yeah, and this will also mention, like, I believe they can, because Satya Nadella, so far, everything he touches turns into gold. the flywheel, if the concept, the flywheel, right? What Amazon also made really popular was like you build something, and based on that, you can sell many other stuff as well. They have multiple flywheels with Azure, whatever it is. Now it's AI that they can integrate into LinkedIn, into Office, everywhere. So they have multiple flywheels, and all they're spitting out cash like hell. Yeah. So for me, it's a clear sign of like, let your winners run. Yeah. If you look at the multiple now 40, it's too expensive. If I would make a case, I wouldn't invest today. Yeah.
Yeah.
But the question is for me is then, should you sell now? And for instance, do a yield play. Okay, take this, what is it, 1% yield and exchange it for a 3% yield and get 3 times more dividend income. And here I would make a case, I don't do it. I let my winners run. I did this once with McDonald's. I sold it and the price went up still 2-3 times from where it was there because I thought it was overvalued. I think if you are a value investor, you might want to do that because you look at overvaluation, undervaluation and such. But this company is so on fire, and that's why I mean, let your winners run. If it's not a winner anymore, we have a different discussion. If it's a company that became mediocre or became a loser, yeah, then we're talking about something else. But we're talking here about a winner dominating every industry they're operating in. So for me, it's like let it run.
It should in theory be easier for dividend growth investors because everyone does because everyone reacts to the price, but you should not really be looking at the share price. So if you could block that out and just focus on the results, and if you never looked at the share price, you would never sell that company, right? So it should.
Yeah, correct. Because I expect also still 10% at least dividend growth annually, like it has been doing. So if it does that in the next 7 years, I will double my dividend income from Microsoft. But what the interesting thing here is, Derek, I think like you look at your portfolio, you see that you have a lot of cash in a single stock. It's my second position, but it's contributing one of the lowest. Yeah, let's say the number 20 or number 30. So you think like, you know what, if I sell this stuff, I can quadruple my dividend income from this holding straight away. Yeah. Of course, there are tax implications because mine went up like almost 10 times, or let's say 8 times. So I would have a lot of cash to send to the tax office, which I also don't want to do. But I think this is really, really, I said, this if you're cash hungry, which we are, it's really screwing your mind. Yeah. And that's why I wrote this article, because after the run up in Microsoft, I spot myself again thinking this and thought like, oh, probably many others are thinking this as well, but I need to let my winners run.
Yeah. Nice one. Joris has asked us, do you guys take inflation into account when projecting your monthly dividend income to become financially free?
Yes, I do that. I've got this retirement calculator template on my blog, and there you just plug in the numbers for inflation. And I think I used the number back in 2014 of 3% on average. Of course, last year was much more. So that's why I also adjusted my target dividend income for that reason. I mentioned that in the annual report that I wrote. So yeah, I do that because you need to look at the real interest, right? Which is your dividend yield minus inflation, effectively, or dividend growth minus inflation, and you've got your real purchasing power growth.
Yeah. No, I haven't yet. I've kept my target the same, and I'll see how I go until I reach that target. But when I get there, I'll see what the cost of living is at that point, and then I might have to adjust it. It just keeps me, because if I keep adjusting my target and I might say my goal is 10%, then I adjust it and it goes down to 8. That would wreck my head. So,
I mean, I know my target, but what I'm trying to say, my target is calculated using inflation, taking inflation into account. That's what I want to mention. And I only adjusted it now once in the last 8 years, and that was because last year's inflation numbers was unforeseen, and if I would continue at the end, I would just do myself short later. So that's why.
Yeah. Michael has asked us, how much dry powder do you keep as a percentage of your portfolio?
None. I still have a little bit of dry powder in general from my bonus, but I try to be fully invested as much as I can.
Yeah, mine's sitting at about 5% at the moment. Mine's sitting at not intentionally. It's just it's just sitting there.
Yeah.
So Joshua, I said, welcome back. What's the longest holding in each of your portfolios? How long and what has its performance been in terms of capital appreciation and dividends?
Oh, let me quickly look that up for him. And that is Chevron is the longest holding. A really small holding. I bought them at $128 per share in September 2014. And I don't know, what is it trading at now? Chevron, let me check. It's now, I don't know. I need to check what it's trading at. But yeah, it was at $128 per share. I see it's now $58 per share. So not a lot of compounding happened there if you look at it like that. But if I look at the dividends, that's actually been paying me quite a lot. And in dividend terms, it has, my investment has been paid back by 30% via dividends over that time. So, but that was, of course, an oil company. Unilever is one that I also own very long already. Yeah. How about you?
Nice. Glanbia was my longest holding. It's one of my first companies I've bought. It's still trading around, so not much in capital appreciation, but like you, I've made 22.7% back from dividends on that company. So not too bad. It's still a small position, relatively small position, but yeah, it's my longest holding. My first company that I bought was Waco, followed by Red Electrica, but I don't own those two anymore. And Glanbia was the third.
Yeah, nice.
Huron asked us, a few months ago, I saw somebody buying one share of Pepsi per week. That's probably Russ from Dapper Dividends. Yeah. What stock would you like to do this with, which could financially be affordable, i.e. not Berkshire Hathaway?
Okay, so if I wanted to do it, I would do a stock that I really would love to own and maybe are less scared about the valuation here, just as a token of appreciation to that stock. And I think I would do that with a company like Nike.
Yeah, I would pick somebody like Texas Instruments would be one company.
Also a good one, yeah.
Kevin has asked us, there's plenty of US mortgage REITs paying decent, stable, double-digit dividends. He's given some examples, AGNC, AMA Residential, and so on. They've got decent track records and stable dividend growth. I have been accumulating these, but noticed these types of stock is not mentioned in the group or podcast. Any thoughts on mortgage REITs?
It's not my circle of competence, Kevin. I just don't understand enough about it, and I've never taken the time to study them. So that's why I'm shying away from it. But Kevin, if you have any information where you say, like, guys, you got to read this, post it on the group for us, on the Facebook group, because I don't mind spending half an hour or an hour one time reading about it to then really judge, is this too hard on the too hard pile for me or not? Yeah,
but exactly that. We don't want to give false information on the show either. So it's something that haven't dug into. I've read some of the names that you mentioned purely because their dividend, as you said, is high yielding, but that's not enough reason to invest in these types of companies. So
actually, to the contrary, if I see 15%, I already think, like, okay, let it go, don't touch it. Must be something wrong.
Yeah, but that could be typical for these types of stocks. I don't know. So
yeah, exactly.
Yeah. So we just let them be. But yeah, I would love to hear resources or how would you reckon we should learn about these? Is probably the best question to ask.
Yeah.
CIP has asked us, how have dividend ETF performed versus your portfolios?
I cannot compare that, because with a dividend ETF you buy a basket of stocks, all those stocks at the same time, and we don't do that. We accumulate stocks over time. We mentioned that we have been buying some insurance stocks more lately, and then other time this. So there's no way I can compare myself to a dividend ETF. I wouldn't know how to. So, but that's also the reason why I don't invest in dividend ETFs, because I believe that there are always some stocks in that ETF that I would like to own at that price at that moment in time, but the others not. So that's why I'm more in favor of stock picking. Although I believe that if there was a decent ETF available to me, I would like to have it as a core. For instance, what I started doing now, because we don't really have access to this SCHD, but I started selling a put option on that in the hope it gets triggered one day. Still, I don't know what it really means, whether interactive brokers will later or regulation will kick in and later force me to sell it again. I don't know. But that's an ETF that I would love to have as a foundation in my portfolio, because I studied the ETF and I like the strategy of the ETF and how it's set up. I think it's a good strategy.
Yeah. Just on the interactive brokers regulation, from my experience, I had some US closed-end funds. When they finally triggered and said we're not allowed to have them because they don't have a KIID, they didn't force me to sell, but I was just not allowed to buy anymore. So I still own one or two because the share price has dropped a little bit and I don't want to sell them at a loss because I know they'll come back, but they didn't force me to sell it. But
good.
But I agree with you. It's too hard. How do you compare? Do you compare dividend growth? Do you compare dividend growth and appreciation? I don't know. We spent, I think, an episode talking about this before. I don't like to compare myself against the market or against what anybody else is doing, because it would make me make stupid decisions.
We compare against our goals.
Yes.
What is our projected annual dividend income for this year?
Yeah.
Did we achieve that? Yes or no? And how much cash did it cost us to get there? Yeah, that's really what we compare to.
Yeah, exactly. Alexander has asked us, do you always sell if a position gets too big?
No.
Yeah,
I think we just had the whole discussion about let your winners run. No. But it is probably good to mention, he says here about this tier, the 4 tiers that I have, like 1%, 2%, 3%, 4%. So I understand where the question comes from. Yeah, and I more look at the tiers even at dividend income compared to maybe share price. It's usually a function of both, but sometimes you just let them be 5% or something like that. But it's about the dividend cut that I look at.
We have a question from Karis. You can see that I'm smiling because I've just read this question for the first time. Bit of a fun question for you lads. And it's a crazy if aliens were announced as real by the CIA or some other authority, do you think it would shake the market, and in what way?
Well, actually, I know there are some theories now, and it's on YouTube. It went viral, of a guy that came forward, I think from the CIA or something like that, that mentioned that that UFOs and such exist, and and now there's this complot. So I saw something popping up on my timeline, but I like it. I mean, might shake up if we get a Mars attack like in the movie, then yes. But first of all, why would the CIA announce it? Yeah, they would only do it when it's like happening tomorrow that we get invaded.
Yeah,
if this is a global war, I think still what over time has proven, being invested in companies and stocks is one of the best wealth protector during a war. So I just don't know if they with one press on the button can wipe out whole society. But in that case, we shouldn't worry anyway.
So I was looking at it from 3 angles. So I'm thinking, okay, if they come here peacefully, okay, for no reason, just to come and mingle, probably not going to have a big impact on the market because nobody's going to care.
Well, I'm long BHP Billiton, because I would only expect they would come for resources mining, because that's why that's why countries usually invade also other countries.
Yeah. So, but if they come with us to invade, okay, the fact that they've made it to us before we've ever met them, they're probably going to be superior to us in terms of armory and ships and guns and everything else. We probably won't have to worry about the stock market because it'll be gone. It'll be gone.
Yeah.
Or if they come and they want money and they have that technology available, they could probably, with a press of a button, do something with the stock market, short all the stocks, take all the money and leave. So I think in 2 to 3 scenarios, aliens would have a big impact.
But even so, I think we wouldn't probably understand most of it, because think about this. I believe that DNA wise, we only differ 2% from a monkey.
Yeah, exactly.
Yeah, but how much consciousness has a monkey? We don't know. How much intelligence has a monkey? We know a little bit about that. But does a monkey understand what we are doing as humans? Probably not.
Yeah.
Now imagine that aliens would also have some form of DNA and are like 5% smarter than us. We probably can't keep up with them, even intelligent wise. So
Well, we'd be so screwed.
yeah, but we would probably even not know sometimes that we would be so screwed, like a monkey. Yeah.
They probably come down and look at our portfolios and run off and say, they're too stupid. I'm not taking their money.
let them be. We would be like fish in the ocean. Yeah. We just harvest them from time to time and eat them, and that's it.
I love these questions. Hussein has asked us, hi all, I asked this before, but it was missed. How do you feel to have all your investment and future money in online broker? Do you see any risk to have all the future income in an app without a representative office in your country?
Well, I experienced this once actually, because a family member died and they were using here in Poland a broker service, but the headquarters was in Greece, and we had an issue there because the person didn't put any relatives in the information as who also, let's say, who is married to, as an example. So we had to threaten with the police, but where do you send the police to? So this was really an issue. In the end, we got our money back, but this was really hard. So there's definitely a point made here, and I have almost all my wealth from stocks in the Giro, which is now Flatex in Germany, plus Interactive Brokers, which is the US, which are foreign companies. They have their entities also elsewhere in Europe, right? But it is an issue, but I'm generally not too much afraid of it because of European regulation. I do feel protected enough.
But does a local bank make it any safer? Look what happened in Greece.
No.
Look what happened in the US just recently. At the start of the year, we had a couple of banks collapse and people could not take out their money. So you might feel a little bit safer, but are you actually safer? I don't know. I think if a bank is going to collapse, whether it's local or online, I think you're screwed either way.
That's true.
Question from Ron, our good old friend Ron, who's financially free, may I add. I think he's asked this before, but he's asked us, how do you decide if you want to keep a subsidiary within a new merged company post-merger?
Yeah, so this is all about mergers, right?
Yeah.
So, and for instance, DSM is a good example of this one. For me, it really decides so it's about decision, right? To keep your subsidiary when within a new merged company. It depends on whether I like the acquirer. What is that kind of company? What is the track records of acquisition? Is it a company that I like to own in my portfolio? Those are really the questions that I ask myself. At the same time, I can also do a valuation because I've got somewhere personally, I've got a kind of a cash flow template where you can put the acquisition details in and you can see like, is there, what should be the fair price afterwards? So if you think from a valuation point of view, I can also look at that. But then the second follow-up question is, if you don't want to keep the new merged company, do you hold until the merger to sell, or do you sell once the price reaches the transaction price? I would wait until it reaches the transaction price, unless it's already trading 1 year before, let's say, or 9 months before, like already at a 98%, then I would just sell it because the additional 2% is not worth waiting. But generally, I would wait.
A bit like Activision and Microsoft, for example. Okay, no, that's the good questions. We still have a couple more, so we'll try get through these. Boris has asked us, hello guys, probably related to you actually. Could you please give us an opinion regarding CIBUS Nordic?
Yeah, actually, I went also into the earnings call and I also asked a question there to the CEO here, and it was fun. You could just ask a written question to the webcast before it. But look, generally, I found their numbers quite good. And especially also if you listen to the earnings call, what I really like, what they have done over the last quarter, they have worked on their balance sheet. So they bought back bonds in the last quarter that were due in September, and I believe even early next year. They've been doing this so that they can avoid already some of the interest payments, because they issued shares during the quarter to do this. So they've been really cleaning up the balance sheet, and they've been hedging their interest rates until I think almost 2025. Yeah, so over the next 1.5 year, let's say, they have kind of secured their cash flow from that point of view. There were also questions about that to the CFO, and the CFO also mentioned it. Like, if the rates would grow still like with so many percent, then this would be the additional impact to our interest rates, right? But those were really extreme cases, which might happen. We don't know what will happen going forward. So what this gave me was a feeling that this management team is really on top of it. It knows what they're doing. It knows where their issue is at the moment in the real estate market for them with debt. They also, what was really interesting, they wanted to buy back all the bonds, but not all companies wanted to do that. So they still wanted to get the interest payments. So they feel, I assume, safe enough that their principal will be paid back. So I think these are also good signals in general. Now, because of the share issue, their earnings power of the earnings per share, let's say, as a company dropped to 91 cents, and they have a annual dividend of 90 cents. So it's really touching almost full payout. The company was also challenged a little bit on this. I think they feel confident, but of course under certain circumstances. We're not talking here about if now the market totally gets a collapse. I think then we will see a dividend cut. But if it continues to be like this, I think we should be fine. So that's my conclusion from the earnings call.
Good. Tim has asked us our opinions on 3 companies: Linde, Air Products, and Air Liquide. What I would suggest, actually 3 quality companies. We talk about quality companies in Europe. There are probably 3 of them that you would put there. But I think the Kleine Capitalist, who was a guest on our show, knows these companies inside out. I think he has a blog post on them, and pretty sure he has them on all 3. But he's quite knowledgeable on all these 3 companies. I would highly suggest reaching out to him, maybe on his blog, send him a comment. He's always writing back, and he will give you a much better answer than I could. Carlos has asked us, what are our thoughts on money market funds like CSH2?
Yeah, I never invested in them. I'm not familiar with it enough to give a meaningful answer, Derek.
Okay. Tom has asked us, any thoughts on UKW? UKW is that's their ticker symbol. It's actually Greencoat Renewables. They're a UK pretty much renewable energy company. If you look at their portfolio, they cover pretty much the whole of the UK and Northern Ireland. They've got a pretty big portfolio, and they generate 1,132 megawatts of electricity, which is quite big from renewable energy, I have to say. I do own them in my portfolio. They are my, would you say, they're my way into the renewable energy sector. We talked about Shell, how can they do it and be profitable? But this company, they have a big, huge portfolio already, and they seem to be profitable. They have a 6% dividend yield. But what I do like is they have a commitment, and they make this commitment to increase their dividends in line with the CPI, which is inflation. So they increase it with inflation. And they've done that every single year since inception. I listened to another podcast called Moneymakers. If you're interested in UK companies, particularly closed-end funds like these guys, it's a great podcast. I've listened to some of the fund managers on that podcast from Greencoat. Very intelligent, very clear. Their goals are clear, and I'm aligned with pretty much everything they do. So I think it's an awesome company, or a fund, awesome fund. And as I said, it's a small part of my portfolio, but I would have no problem adding more as well. And then the last question is from David, and he's asked us, can we do a review and give your thoughts on Gladstone investment? Honestly, we took these questions in just before the show. It's not enough time for us to do a review. I've heard of the company. I know it's a BDC. I know it has a decent dividend yield. but I don't know enough about the company to do a review in about 2 minutes from them. But I know Dividend Bull, I think it is on YouTube, loves these types of companies and mentioned these a lot. So I would recommend checking that guy out.
Awesome. That's the end of the show, I would say, right?
Yeah, it's jam-packed. We did say it was jam-packed.
Yeah, but it's awesome. I mean, the community continues to be engaged. I love it. And it just made me also look forward again to our first episode after the summer break.
Yeah.
I mean, thanks again, Derek, as always.
And thanks to you, and for all our listeners, again, apologies for last week, and we see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.